Hello, class, and welcome to our third lecture series on our very exciting subject, Principles of Accounting or Financial Accounting. And I'm your instructor, Jamal Haider. So today we are starting chapter 2, which is transaction analysis. And from now on, we will be talking about, or basically we are diving into the very basic core of accounting subject. And today I hope we will cover about the rules of debit and credit and all those stuff. Okay, so let me turn off my video because we are using the e-pen to make you more understand why or where these figures are coming from and where I am focusing. So let's start. Okay, for our first learning objective is that explain what is a transaction. So let's talk about this. So any event that has financial impact on the business. Now, what do we mean by financial impact? It means any event that involves money, right? We call this is a transaction. Yes, this is called transaction. Plus, the other characteristic is that it can be measured reliably. What do we mean by reliably? So it doesn't mean that, the
Hello.
Okay.
Sir, I cannot hear you. Is it my computer?
Okay.
Yes.
No, you're not the only one. I think everyone couldn't
It's
hear
kind of
you.
lagging. We cannot hear it.
Okay, now can you hear us?
Now I can hear you. Yes. I think I'm not the only one.
Yeah, all of us.
Okay, now?
Now we can hear you.
Now we can.
Okay, let me start again. Okay, so the transaction, so any event that has a financial impact, which means the monetary effect on the business, like the cash is coming out from the business or coming into the business, like we call this inflow or outflow. And the second characteristics of transaction is that it can be measured reliably. What does it mean by reliably? For example, if CEO is working for the company and the board of director, they are responsible to, elect CEO and also responsible to allocate him his salary. But CEO also has other company, for example, and that company is providing raw material to the company where the CEO is appointed. So, for example, the CEO company provides raw material to this company of 10,000, but the real market value of this raw material is 8,000. Since you are the CEO and you have the authority to approve it, you approve 10,000. So in that case, you are committing fraud, right? So remember, so transaction must be measured reliably. It can have different implications. For example, it should be according to market rate, right? And it should be justifiable, which means no judgment involved. When there is a judgment, there are chances of fraud. So basically information, let me just remove all this mess here. So the third characteristic is that it provides information about exchange. How? That in a transaction, something is giving and something you are receiving. And the accounting, it records both sides. So I gave you the assignment 1, you have seen over there, right? If cash is paid to account receivable, you see cash is decreased and account receivable also decreased. If you pay on account means that you are paying your suppliers are also decreased and cash is also decrease. So we are recording both sides, the giving and receiving sides. So example of transaction. So we have a Whole Food Incorporation. So if they purchase a fresh produce and sell product, borrow money, repay the loan. Can you tell me the give and take here? If they purchase fresh produce, what is the given side and what is the receiving side? So given side, for example, they purchased on cash. So it means cash is affected, right? And what is the position of cash? Cash is given. And what they have received? Inventory. Why? Because this company deals with foods. So for them, inventory is food. Received, right? So when they sell the product, what is given and received? When they sell, what they receive? Sales. Or you can say they receive cash. What they have given, they sell their inventory. Similarly, when they borrow money, what happened? Cash is received, right? And borrow money, you'll create a liability. Liability is also give and take, because you have to give back the money. Or if specifically from bank, so you can also create a liability, bank loan or something, right? Repay loan, what happened? What you have given and what you have received. You repay loan, cash is given, and what you have received, a decrease in liability, right? Decrease in liability. So any transaction which have financial impact on company must be experiencing two sides. One is given and one is received side. Okay, any question? So here comes our learning with the 15.
Sorry, you mentioned about like judgment. What does that mean? Like no judgment.
Okay,
Does that
judgment
mean we're just talking about
okay.
numbers?
No, judgment means your own opinion. For example, the company is giving you salary of 10,000, but you think your salary should be 20,000. That is your judgment. And that is a fair way, because company compare the salaries with the market, but you are comparing the salary according to your own sense, own wisdom. So when judgment is involved, then there is a chance of fraud. So anything that involves judgment, accounting strictly prohibit that. You should not use any kind of judgment. For example, the board of director, they elect CEO and they are responsible for compensation of CEO salary as well. But if CEO also a part of board of director. So if CEO voted in the favor, and for example, the board of directors are his friends or his family members, and the market rate of CEO's salary, for example, $2 million annual. But the CEO says, since we are brothers and we have a pact together, I voted for your salary increase, you voted for my salary increase, and they increased his salary to 5 million. So does it justify with the market? No. It's purely based on judgment, because we are friends or we are families, it's like that. So anything that involves judgment, your own analysis, maybe the CEO is really hardworking, but that justify according to the market rate? No. You can give him some bonuses, but you cannot, justify his salary of 5 million. So you understand my point? What do we mean by judgment?
Yeah, I think I do.
Okay. So it means your analysis, which involves judgment, like some kind of, which is not based on some kind of concrete market analysis or real numbers, that fall in the category of judgment. Right? Okay, now let's define account and list and differentiate between different types of account. So we already know that our accounting equation, we also call this balance sheet equation, assets is equal to liabilities plus owner's equity or shareholders equity. So account means it records all the changes in a particular asset, liability, or shareholder equity during the period. So account means basically these are the summaries or different titles that belongs to whether assets or liabilities or shareholder equity. So we already talked about what kind of assets like cash and cash equivalents, right? These are called the accounts. So assets, we already talked about that. These are the resources. Which kind of resources? Economic resources that provide a future benefit. Number one, cash. So this is an account which records all kind of money transactions, including bank account balances, paper currency, coins, certificates of deposit, and checks. So I won't be wasting so much time here because we already talked about each and everything one by one, its definition. But we are learning here with respect to account. So account receivable, this is the account for assets, which records all the transactions related to customers, right? So it is a promise for future collection of cash from the sale of goods or providing services. Notes receivable, it is a promise for future collection of cash. Customers sign the note and also mention interest rate. So I already give you the example of note, that if the customer requiring some kind of credit period, you can say that, look, if I give you some kind of like 3 months or 4 months time to pay my cash, what if I deposit that cash to the bank? I earn some kind of interest. The customer says that it makes a point. What if I give you that interest? So you give me the goods, I give you money after 3 months plus some kind of interest. So when this transaction happens, we call this notes receivable. And remember, in note receivable, so that the difference between account receivable and note receivable is interest. In account receivable, there is no interest that you will receive, but in case of note receivable, this is a major factor of interest received. This is interest rate, not paid, it is received from customers. And then inventory also belong to asset account. So all kind of goods that company sells to sells to the customers, that belongs to inventory account, and that belong to asset that belong to our assets. Prepaid expenses, we already talked about that. These are expenses paid in advance, such as insurance, rent. So all those expenses that we already paid in advance, that will fall under the category of prepaid expenses, and ultimately these are the part of our assets. Land, similarly, the cost of land used in operation. And what do we mean by cost of land? So all kinds of expenses that we incurred